Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, CIO of Starkiller Capital, Leigh Drogen. Starkiller Capital is an institutional investment firm applying quantitative, data-driven strategies to blockchain-based digital assets. On the show, we discuss core tenets of their approach to crypto investing, trend following and yield farming in crypto, their approach to risk management, his top emerging trends in the digital asset space to have on your radar, and more. So with no further ado, here's our show on quant investing in digital assets with Starkiller Capital CIO Leigh Drogen. All right, we got Leigh Drogen on the podcast today. Leigh, welcome to the show. How are you doing?
Awesome. Pleasure to be here.
Great to have you, and excited to chat about Starkiller Capital and all things crypto today. It's a super exciting asset class. It seems like there's so many opportunities, constantly changing. But prior to getting into that, I'd like to do a quick overview just of your background. I was going through your bio, quite a few accolades there. Named to Forbes 30 Under 30, been recognized as having built one of Forbes' 9 hottest startups, along with Goldman Sachs' 100 most intriguing entrepreneurs. Quite the list, so kudos for those accolades. Could you give us a quick background on your journey in entrepreneurship and the capital markets?
Yeah, so my academic background starts in behavioral economics and war theory. And out of that, I went straight into being a quant at a hedge fund in New York, running event-driven and stat-arb strategies, which I loved that world, coming to work every day and kind of putting together the puzzle that was, quantitative models. But I got a really interesting opportunity in early 2009, to join a very nascent fintech startup called StockBlitz, which many people might be familiar with, the Twitter for finance. And I ran product and biz dev there for 2 years, building that up. And I loved the process of building something basically from scratch, iterating on user acquisition and all of the things that users were doing inside of our product. And out of that experience, I ended up leaving after 2 years to found a company called Estimize, a startup which was eventually venture-backed. And at Estimize, we built the now largest crowdsourced earnings estimates platform in the world. So instead of collecting earnings estimates for publicly traded companies from sell-side analysts at banks, we collected them from buy-side and independent analysts. And not surprisingly, the data set ended up being far more accurate than the classic sell-side estimates. So out of that, we built kind of mid-frequency, high-sharp alpha factor models. And we also sold the raw data to most of the largest quantitative hedge funds in the world. I ran that for about a decade until it was acquired in 2021. And in 2013, I started to kind of get involved in the crypto universe as Bitcoin really got going. But kind of my experience spans everything from, deep TradFi finance to the most entrepreneurial, early stage startup aspects of fintech.
Great, thanks for that. And you mentioned crypto in 2013, so I'm intrigued in hearing about, everyone has a Bitcoin moment, but prior to getting into that, I did want to touch on your background in quantitative investing. What exactly appeals to you about being a quant and systematic investing?
Well, I think, and this is really how my mentor, my first boss at Geller Capital explained it to me, is that different types of investing are suited more or less to different types of personalities, right? And, I am not a value investor. I will never be a value investor. I would be a terrible value investor. I simply don't have the conviction to say that I am right for long periods of time and the market is wrong and stick with that. I think, I like to say strong convictions, weakly held. And that is really the type of persona that works well in the quantitative space, where you're just trying to put the puzzle pieces together in a concerted, process-driven fashion every day and stick to that process. And theoretically, if you do good work and you are intellectually honest with the work that you've done, that process usually leads towards, good results, good returns. I don't think I could go through, being a value investor and taking huge concentrated positions and wondering if I was right or wrong for years on it.
Yeah, and it's investing strategy and mind frame that I feel really translates well into the digital asset space. And our approach and my approach at Accelerate, I always thought that crypto must have been like equities in the 1950s or 60s, just highly inefficient, tremendously undeveloped with tons of opportunities if you can effectively port over skills and strategies from the TradFi equity markets, which are highly developed, highly efficient, particularly in the US equity market, which is the largest and most liquid by far in the world. Now with that, transitioning to Starkiller Capital, which is your firm focused on the digital asset space, obviously still a fairly new and novel asset class. Most firms still don't even invest in it for the most part. But prior to getting into the strategy there, I was wondering what first got you involved in crypto?
Yeah, so I kind of saw Bitcoin come onto the radar in early 2012, and I looked at it as basically being a digital religion of sorts. I think in the crypto world, there are really two broad philosophical factions. One of them is the kind of Fed-hating, gold bug, societal collapse, kind of fiat currency is going to be replaced type of set. And then the second set is more on the technology side. We're going to have more efficient kind of payment rails and collaboration and all sorts of kind of just next generation of the financial system thinking. At the beginning, it was very obvious that what started this whole thing were the religious, kind of cypherpunk, Fed haters that really got Bitcoin going. And I thought that was really interesting in and of itself as an investment, because if you could invest in a digital religion that was self-proselytizing, would you want to? Yes. Like that's a pretty incredible kind of setup there.
Yeah, no, that makes a lot of sense. And I believe that religious conviction has only cemented further over the past dozen years since you first sort of noticed that dynamic. Now, one of the things that you've written is, and I thought this was a really interesting theory, you stated that the most important paradigm shift crypto provides is the embedded incentive structure to bootstrap network effects inside of decentralized systems. Can you explain this thesis?
Yeah. So in 2013, I started to put money into Bitcoin. More in 2015 under the same exact kind of theory of the investment itself. But in early 17, I think my thinking really started to change around the asset class and the ecosystem. And that was really as Ethereum got going and we started to see the very early kind of nascent applications built on Ethereum. And the whole thesis shifted to this idea that while you're still going to have kind of the digital religious aspect to it, and certainly Bitcoin, the application of Bitcoin is digital gold still, and that application is winning really big. The idea that, and I'll use this kind of metaphor, when you look at how Uber grew, they raised tens of billions of dollars in venture capital, and then they basically subsidized both sides of a two-sided market, the riders and the drivers, because they knew that at the price they would have to pay the drivers and what the riders would have to pay, they would never get the network going. So they had to subsidize it. So they raised all this venture capital and they threw it that way, and it worked, but they had to spend all this money and give away a very significant portion of the firm to VCs who really didn't do much except for provide the capital. One of the main ideas in crypto is that because the quasi-equity kind of aspect of the tokens, and some of them are more equity-like than others, can be handed out so easily to the participants in a network that instead of raising tens of billions of dollars of venture capital and subsidizing the network, what you can do is you can slowly give out equity in your project to the people who are actually helping to give you the escape velocity on the liquidity of that network that you're trying to build. So whether it's a lending protocol or a decentralized exchange or a mapping protocol, we have some of those in crypto. We've got all sorts of different applications that require this kind of liquidity and network effect. And I think that one of crypto's main advantages and why you will see many, many projects launching in that way instead of the Uber way is that it allows for more experimentation in building liquidity inside of these networks, to do it faster and to be able to give your the participants in your platform equity, which I think is great because they become evangelists, right? Like we're the riders and the drivers of Uber early on, evangelists, for the platform just because they were being subsidized a little bit. Not really, but if you gave equity to everybody early on and they had the incentive to go tell everybody to go use the platform, I just think that that's an incredible advancement in the ability to build these things.
Really interesting. And as I understand, your strategy within crypto has two main sub-strategies, and if you will, of momentum and yield. When you talk about the advantages of the network effects in crypto with experimenting in liquidity, one thing that gets talked about a lot is yield farming and how funds will come in and other participants and yield farm within these different protocols. Can you just talk a little bit, we will get to the momentum aspect as well, but can you talk a little bit about how your strategy is similar or differs from typical yield farming?
Yeah, so we run in our market neutral yield strategy a series of different kind of sub strategies within that to yield farm. And they go from basic providing stable coins into lending protocols, so very vanilla type stuff, to a little bit less vanilla stuff like staking yield-bearing instruments inside of fixed yield protocols like Pendle at term 3, 4, 5, 6 months, to more interesting stuff where the main part of the strategy is that we are deploying stablecoins into new launch protocols, whether we have a existing kind of side deal with the protocol from the earliest stage of their launch, where we're going to provide liquidity for X amount of time, 6 months, 12 months, and we're going to get both the native yield of staking those stablecoins inside of the protocol, and we're going to get extra governance tokens according to this kind of side deal that we have over some course of time. And then, sometimes, or in a lot of cases, actually, there will be no side deal, but we will go and pick projects that we believe have the best chance of being really big when they do their token offerings. And we will farm those protocols by, again, staking stablecoins or doing other market neutral operations inside of them, believing that the airdrop will eventually be, lucrative. And, the main component to all of this is not necessarily the kind of VC aspect of picking the biggest winners. In VC, it's really that power law distribution, and you don't care if 80% of the stuff goes to zero. You just really need to hit that one big home run. In this strategy, it's really, you need to make sure that there are no zeros because you cannot lose the principal. So there's a ton of risk management that we do to really do a deep dive on these protocols up front in terms of their safety and provenance of the code of the protocol, knowing the founders, knowing who backs the founders. And then there's that kind of right tail of, if you do get it right in picking which ones you provide liquidity to, you can get that big right tail of, of big returns. But it's a very low volatility, high sharp strategy versus, just kind of deploying into everything that has the biggest APRs.
That's interesting, Leigh. You mentioned basically participating in kind of new tokens. I assume a lot of large liquid tokens as well. What is your investing universe, and how do you approach the whole market?
So for the yield strategy, we can go into anything because we're mostly liquidating the actual, beta exposed tokens when we receive them. And, it's little bit by little bit. So there's no real concentrated positions that we have to worry about liquidity there. Although for those protocols in the yield strategy, we have to position into those pools at, our size to make sure that we're not too big a percentage of any given pool. And so at any given time, we're in 10 to 25 different protocols in terms of providing liquidity. In our long, flat kind of trend following strategy, which trades all of the liquid tokens, our universe is really dependent on how much liquidity there is in the market at any given time. At the bottom of the bear market in late 22, we're talking about that universe really contracting to something like 100 tokens. At the top of, in January, the recent bull market, we're talking about 400 tokens. And out of those, at any given time when our trend following models say that we should be, significantly beta exposed, we're in 20 of them or less.
So is that how your trend following model works? Is it's very binary, where there will be times where your trend following strategy will make up the vast majority of your allocation, and then other times where the binary option will be off and you would be strictly focused on yield farming? Can you, on the yield aspect, can you give a little bit more detail on how you think about those two different strategies and the allocation between them?
Yeah, so this is kind of the evolution of our firm wrapped up in kind of that mix. When we started in October of 2021, when we launched the firm with outside capital, we were running the trend following model with the yield strategy really only taking place in a big way when that trend following model went to cash. Now, we've always been kind of doing airdrop farming by trading in different places and participating in different protocols. But the majority of that yield, really came, and the focus in that strategy comes when the trend following model goes to cash. Over time, what we had our investors come to us and say, hey, could you run the yield strategy in a separate portfolio for separate capital? And about 20 months ago, we said, yeah, we can do this, and basically set up a side pocket for investment just into that strategy. And that went obviously really well. And so actually on July 1st, that strategy will stand alone in its own vehicle, completely separate from the trend following beta exposed strategy. And we'll continue, obviously, to run yield inside of the main portfolio, but there will now be a separate book just for that in its own in its own vehicle. So we're really excited. But yeah, it's really not a matter of how much you deploy into each. It's really kind of the overlay, and when the trend following model really just recedes into the background for sometimes long periods of time as we go through these bubble and bust cycles in the asset class.
Speaking of which, you guys have come a long way since launching in 2021, right before one of the bust aspects of the cycle, 2022. Obviously a challenging year, but since then, things for the most part have bounced back, and you're seeing positive sentiment in certain aspects, whether it's meme coins or crypto treasury companies, of which are really springing up multiple per day these days. But from your perspective, how would you describe the current state of digital assets and investor sentiment towards the asset class?
So I think we've gone through this incredibly unfortunate period of time, basically between early 22 and really just a couple months ago. Even though returns have been good during that time, I think it's been an unfortunate time because the cynicism associated with the asset class, rightfully so, has gotten incredibly high. And this is why. In the US, there was a concerted strategy by the Democrats and a whole lot of Republicans as well, who have very deep ties to the banking system, to try and slow down the asset class as much as possible at the behest of the banks. And the reason that they attempted to do that was because they felt that regulating the financial system through banking intermediaries was the safest way to do it. And this comes out of obviously what happened in 2008 and, needing to have their arms around the neck of the banking system, or as they believe. And their main strategy was to use our Securities Administration to basically refuse to allow a pathway for projects to register their tokens as securities, which means that they can't imbue their tokens with any real intrinsic value. And so all of these governance tokens, all of these utilities tokens, they're all just Chuck E. Cheese points, right? They all have no intrinsic value. And when you can spin up an infinite number of these Chuck E. Cheese points, what is each of them actually worth, right? The eventual conclusion to the cynicism around that and how VCs were investing in projects, the projects were doing token offerings that were, completely intrinsically valueless. Even though the projects themselves were valuable, the equity in the project was valuable, the tokens were not. The eventual conclusion to this was meme coins. And this is where you see kind of the explosion in meme coins as just a reaction to, I can't invest in all these other things because the VCs are just going to dump all their coins because they're worthless, and they have exposure to the equity of the project, which may be doing really well. So meme coins rise, right? But more recently, what's happened, and this is where I think everything is going well now, and the future of this, is you see a shift in the US regulatory structure towards allowing a pathway to registration for crypto securities, even though that is not technically a thing yet. And the projects will be able to imbue their tokens with the full equity value of the project and the revenue. And if you look at what's going on in kind of the cross-sectional performance of tokens, within our liquid universe, it is just so obvious right now how the market is treating two different sets of projects. One set of projects that are not conferring any equity value or revenue back to the token holders, and the other set which are. And that latter set, you look at things like Hyperliquid and Maker, there's only a small handful of them, right? But they are absolutely crushing everything else in the market right now. Even really high quality projects that just have crappy tokenomics on the other end. And I think that everybody is now really looking up and taking notice of this, and you're going to see everybody shift in the direction of, okay, it's time to grow up. We have to confer value to the tokens. We can't have these dual equity and token structures. The market is just going to punish that forever. And I think that's going to move our asset class a long way towards reducing the cynicism in the sentiment. And that's what you're seeing right now. Bitcoin has done really, really well because the application of Bitcoin is digital gold. Everything else that is not an application, that is an L1 or an L2 or a utility, token with no actual value, or a governance token with no actual value, those will all continue to decline in value and price because we have an abundance of block space. We're not, 2018 when block space was really, slow, inefficient, and scarce. Like, there's so much block space out there that, we're moving from what we used to call the fat protocol thesis to now the fat app thesis, where kind of you want to be investing in apps, you don't necessarily want to be investing in, core protocols.
It's a very compelling thesis. Now, another aspect of that's really kind of core to your strategy seems to be risk management. And crypto is notorious for its volatility, boom bust cycles, huge drawdowns, massive booms. How do you think about risk management in digital asset investing?
So in early 2017, I sat down with a friend who runs a pretty large equity quant asset manager, and our basic thesis at the time about this asset class was that the assets would mostly continue to be intrinsically valueless, for a long period of time. And that until we reached some kind of, full adoption of both the holding the assets, which we're at maybe, 4 to 6%, globally, even domestically in the US, like we may be at 8 or 10%, maybe. And that's just like, do you hold any? And then the adoption of the technology itself for real use cases where we are less than 1% now. Until we got to some kind of full saturation on both of those, you were going to continue to see these massive bubble and bust cycles. And it's totally rational that these assets would trade in some order of magnitude band of valuation, because nobody really knows how to value these things given the addressable market is the entire world. The technology is going to touch eventually every aspect of value transfer. And so if you look at other asset classes historically that have assets that behave in this kind of similar fashion where they're relatively intrinsically valueless and can trade in huge order of magnitude valuation bands, you look at something like the commodity futures markets of the early 1980s. And that is really where the classic trend following models cut their teeth. And so we took the classic models, not rocket science at all, and we applied them to crypto, and we found that they do a really, really good job at really just taking you out of the beta exposure during these big 70, 80, 90% drawdowns, which again are totally rational for our asset class. It doesn't mean that things are, that the technology has gotten any worse or that adoption isn't progressing. It's just a natural outcome of the change in the technology and the adoption rate. You historically, just on a very basic math level, it's not impossible, but it would be completely ahistoric to have an asset class growing at the rate that crypto is growing without the associated vol that we see in crypto. There is no free lunch. You can't have the growth without the vol. So these models do a really good job of taking you out of the beta. And really, if you look at if you believe in the beta of the asset class over a long horizon, your job really is to limit those drawdowns, because the basic math around if you have a 35% drawdown, you have to make, I believe it's like 48% or something like that to get back to break even. But if you have a 50% drawdown, you got to make 100%. And if you have a 90% drawdown, you got to make 1,000% to get back to break even. So the total return at the end of 3 or 4 of these cycles, if you simply keep that drawdown to something like 30 to 40%, instead of really tipping over that like 60% level, even if you give up, half of the returns on the upside, you are absolutely crushing the return of taking the full drawdown, the whole cycle.
I did just want to go back quickly to the transition in your mind from the tokenized space to intrinsically valueless tokens to, the pathway being there to provide value of the underlying protocols to the holders. Is that a space? Do you think that NFTs can do that as well? Are they included in that thesis, or do you think there's other aspects, lack of fungibility with many of the protocols within that space? Is that an issue that would constrain it? How do they fit in?
So the way that we see NFTs is that the last big round of adoption on NFTs was both experimentation on the core kind of concept, which I'll get to in a second, and the idea that ICOs had been deemed illegal in the US. And this was basically a backdoor way to do an ICO. So, a developer would publish a bunch of, NFTs you could mint, and they would basically do an ICO that way, but say, oh, we're just selling art, right? Very obviously, this was a securities offering, and many of them are getting pinched for it now. But the underlying concept of being able to confer ownership over something unique to one or many people at any given time, I think is an incredible advance in the technology that has a long-lasting, there's a huge roadmap associated with that, whether it be concert tickets or the digital ownership of different collectibles. There's all sorts of really amazing things to do with that. One of the examples of where that part of the roadmap fell down, which intersects with the regulatory kind of regime that was terrible over the last number of years, is when you look at something like producing a song and then attempting to sell the right to the revenue stream of that song to people on the blockchain, right? Which I think is an amazing concept, right? It's the same thing. We go back to this idea of bootstrapping network effects, right? So if you love going to concerts and you love this band and you think they're going to get really big, why shouldn't the band be able to tokenize their an NFT, release NFTs of that song that confer the revenue associated with the digital rights to the song to the holders of that, and then you, as the holder, should go out and evangelize for the band, right? Like that's music, that's culture, right? Why are we doing that? Well, it's because that would be a security, right? It's a security, it's a securities offering. It's very obviously that's what it is. And so we haven't been able to do that. I think that when the securities laws catch up to the ability for the technology to confer ownership over certain rights to revenue streams and the ownership of the underlying, the underlying material, whatever that might be, whether it's a movie or a song or whatever it is, I think you're going to see an explosion in that type of stuff. And you will likely then get kind of the second coming of NFTs once the utility matches the ability to marry it with the actual legal value.
Now, double-clicking on emerging trends and opportunities, admittedly, a couple of confessions here, I did not mint CryptoPunk, nor did I participate in the Ethereum ICO, both of which I wish I could go back in time and participate in. That said, always on the lookout on the next big opportunity, the next big theme that's going to kind of explode in popularity. What's on your radar in terms of potential, 10x, 100x opportunities that have just tremendous growth potential?
So I think we're waiting on an eventuality of a large TradFi financial institution using one of the main DeFi protocols as a back end to get everybody into DeFi yield. And this will probably look something like a Robinhood or a Schwab, probably not Schwab right away, but probably a Robinhood or, certainly a Coinbase, even though I wouldn't put that in kind of the TradFi bucket. Leveraging an Aave or a Morpho or something like that to seamlessly allow their users to put money into basically stablecoin yield lending, stablecoin lending. And the users will basically never know that that's what it is. They won't have to interact with the blockchain, but yet it won't be custodied by Robinhood. It will just be a very seamless user experience where they click a couple of buttons, they're given a wallet inside of Robinhood or something like that, and their stable coins, go straight into a Morpho vault or an Aave vault. And that will start to push just a tremendous amount of capital into the space and provide the liquidity to do all sorts of other things. And I think, the growth of stablecoins with stablecoin legislation just being passed or about to be passed in the U.S. The Senate will vote. The House will vote on it soon and send it to the president's desk. J.P. Morgan is about to basically launch a stablecoin on Ethereum. This is happening. There's going to be trillions of dollars in stablecoins inside of decentralized, blockchains, and the main kind of outcome of that is going to be lending and trading, right? There will be all sorts of other non-financial use cases for sure, and we've already seen a bunch of them, pop up. But in terms of what will grow the fastest first and what will be legitimized first, we have all the pieces now to make this a real thing, and it's going to be lending and trading.
And you believe that will be driven by TradFi, large TradFi firms coming into it now. With respect to institutional investors, I think some have maybe dipped their toe in the water a little bit, but not really. The vast majority of large institutions are not yet in the crypto space. So what advice would you give them looking to enter the asset class?
So there are really, I think, three ways to look at putting money into funds that allocate, right? You have the kind of beta exposed, you have your venture funds, and you have your kind of market neutral type arbitrage strategies. What you really need to understand is how much vol are you willing to take? Like, what is your risk profile? Now, the VC funds, obviously, up to basically 22 had some really great returns, even though, as we all know, the kind of illiquidity associated with those and long kind of holding periods that you've got to allocate capital to, and the broad dispersion in outcomes amongst VC funds, that's all part of that game. After 22, the VC firms have had a much harder time, because of what has gone on in the liquid market after the tokens come public. And so Cliff Asness from AQR would call this kind of the volatility laundering aspect of privates, and not being able to see the returns or the vol, but the vol is there. So just being cognizant of the fact that while you can't see the P&L of the fund every month, the vol is definitely still there. On the liquid side, there aren't that many funds that actually manage risk. And so just being really cognizant of, if you're allocating to funds, understanding what their risk management strategy is, what their max drawdown kind of levels are, and what they're designed to do. Because my fear, and I saw this in 22, is that institutions that allocated without any risk management in their strategies, they tend to puke up the beta right at the wrong time of the cycle. Because they lose conviction, they lose religion in the long-term kind of growth of the asset class. And of course, any asset that draws down 70, 80, 90%, you're going to question your fundamental conviction in the underlying kind of thesis, right? That's the natural thing to do. But when something draws down 30 or 40%, you don't tend to, question the conviction in that thesis quite as much. And so just understanding kind of what you're getting yourself into on that end, I think, is really important for allocators. And I would encourage allocators to go into both risk managed and on-risk managed strategies. You just really have to understand which one it is so that you can manage your own emotions relative to that P&L at different points in the cycle. And then, in the market neutral and arbitrage space, this is really a function of not the risk management on drawdowns and stuff like that, but how cowboy-esque are the teams getting in terms of their picking and choosing which protocols they're going into. I was on a call the other day with an allocator who had invested in a fund back in 2020 that had been in Terra Luna, not Luna, but in Terra, staking into Terra, and they lost a good portion of their capital after having great high sharp returns because they didn't understand the construction of the underlying protocol that they were parking money in. We at Starkiller, we had farmed Terra as well, but we understood that there was a ticking time bomb at the center of this thing, and we had withdrawn all of our capital 2 months before it blew up, because we understood kind of the mechanism for why that might eventually happen. And so really going deep with the teams on, do you read the code? Do you read the audits of the code? Do you know the founders? Do you know kind of the existential threats to your book that look like a LTCM moment? That, I think, is the most important part of the diligence. It's not, oh, are you running a 5 sharp or a 3 sharp? Are you doing 17 or 20% returns? All those things are irrelevant relative to the kind of doomsday, kind of moment that some of these strategies can can get hit with.
Yeah, thanks for that. A few themes there. Know what you own, do your due diligence, and never risk more than you can lose in this novel and rapidly evolving asset class. So well said, Leigh, and thanks for coming on the show. Super exciting to have you on and chat about all things crypto, particularly from a higher level, more sophisticated approach rather than a lot of the beta and just kind of throw it all in there and wish for the best. So thanks so much for sharing your wisdom today, and wish you all the best.
Much appreciated, guys. Thanks for having me.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.